Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
$11.07. That is the number staring back at us from the pre-market screens this morning, January 29th, 2026. Just yesterday, Joby Aviation closed at $13.37. We're looking at a violent plunge of over 17% before the bell even rings. The volume is heavy, the tape is red, and all that momentum we saw just seems to have hit a wall.
It's not just a wall, it's a reality check. I mean, you can't just drop a $1.2 billion capital raise on the market, and that was upsized from $1 billion, mind you, priced at $11.35, and expect everyone to just shrug it off. That's a 15% discount to yesterday's close. Investors are waking up to the harsh math of this business. Their slice of the pie just got a lot smaller.
Or it's the moment Joby secured its survival through the finish line. We have to look past the intraday ticker for a second. The real question today isn't about a one-day drop, as painful as it is. It's this. Is this aggressive dilution a sign of weakness, of overvaluation? Or is this the war chest that guarantees Joby survives that last mile of FAA certification while others fade? I'm the advocate, and I argue this is a strategic move that actually cements Joby's dominance.
And I'm the dissenter, and I'm going to argue that this is an alarming valuation reset. When you look at the mechanics of this deal, the convertible notes, the hedging, the sheer size of it, it signals that the road ahead is, it's just a lot longer and more expensive than the bulls were pricing in.
All right, let's get into it then. I want to start by addressing the panic directly. The market reaction we're seeing this morning is classically short-sighted. It's focused entirely on the share count, not the balance sheet. We have to zoom out. Joby is transitioning. It's not just a speculative tech play anymore. It's becoming an industrial manufacturer. When you announce a raise of this size, $1.2 billion, you are not just paying the light bill. You are building a fortress.
A fortress built with the shareholders' money.
Necessary money. Look at the result. On a pro forma basis, Joby now has cash and investments that are probably over $1.5 billion. Now think about what that means in this industry. We saw Lilium face, potential insolvency. Why? They ran out of runway. Joby now has liquidity to get through the entire type inspection authorization phase, the TIA, without any fear of bankruptcy. That liquidity is the ultimate competitive mode. It takes the going concern risk right off the table.
Okay, I understand the cash is king argument. I do, especially now. But I don't buy that liquidity alone justifies this premium. You're talking about a flight to quality, but let's look at the price tag. Even after this huge drop, Joby's market cap is still over $12 billion. That's more than double its closest U.S. competitor, Archer Aviation, which is sitting around, $5.7 billion? You are paying a massive premium for a company that just told everyone unequivocally, we need more money now.
They didn't need it to survive tomorrow. They raised it to dominate for the next decade.
But look at how they raised it. This isn't just a straight equity offering. It involves $600 million in convertible senior notes. And here's the part that I think a lot of people miss. The Delta offering. This mechanism lets the buyers of these notes borrow shares and short the stock to hedge their position. You're structurally inviting short sellers into your capital stack. You're creating a technical ceiling on your own share price.
That's a technical constraint, sure, but it also shows institutional demand. They upsized the deal.
They upsized it because they offered a 15% discount. That signals skepticism, not confidence. I mean, if the smart money really thought $13.37 was a bargain, they wouldn't demand the stock at $11.35. This just validates the view of skeptics like JP Morgan, who have been calling this a high-conviction short. You can call it a war chest. I'm calling it a repricing of risk.
I think you're confusing skepticism with opportunism. But let's dig into that smart money idea because the data tells a more complex story. You mentioned the mechanics. Let's talk about the market microstructure leading up to this.
Gladly. Because if you want to understand why this stock is tanking, you have to look at the dark pools.
Right. Okay, let's just define that quickly for anyone not staring at a terminal all day.
Sure. Dark pools are, private exchanges. It's where the big players, hedge funds, banks, Trade huge blocks of shares away from the public eye so they don't move the market instantly. Now, look at the data from mid-January. On January 13th, the off-exchange short volume ratio spiked to nearly 64%. The day before, it was almost 63.
Which is high, I'll grant you that.
It's exceptionally high. It was consistently hovering near 50% or more in those venues. This suggests sophisticated players were sniffing this out. They were positioning for this exact event. And now, short interest is sitting somewhere between 9.1 and 9.5% of the float. That's over 56 million shares sold short.
See, I interpret that data very differently. You see a trap. I see a coiled spring. Yes, the short volume was high. They were likely anticipating a capital raise. But despite all that short pressure, the company still managed to upsize the offering from $1 billion to $1.2. That proves there is huge institutional demand to be long this name, even if they wanted a discount to get in.
Demand for the notes, maybe, but the equity is what's suffering.
But look at the days to cover. It's sitting at around 4.5 days. That's the powder keg. If we get any positive news from the TIA testing, which we know is coming, you have nearly 10% of the float that is suddenly scrambling to buy back their shares. That's a short squeeze scenario.
That's a compelling argument, but it ignores the delta hedging loop I mentioned. Let me just explain how that works because it's critical. When an institution buys a convertible note, they're hedged. If the stock crashes, their debt is safe. If it soars, they convert. So to lock in a risk-free return, they short the stock now against those notes.
Right, they're hedging.
Exactly. And the problem is this creates structural selling pressure. Every time the stock tries to rally, there's a mechanical incentive for these funds to sell into that strength to rebalance their hedge. It puts a lid on it. So even with good news, the rally gets sold into. It's not about sentiment. It's just math. The stock is fighting its own capital structure.
That lid is temporary. The fundamental story is about certification, not arbitrage. And frankly, I would much rather have a suppressed stock with $1.5 billion in the bank than a high-flying stock with 2 months of cash left.
Well, that brings us right to the valuation comparison. You mentioned Archer Aviation. Joby's at $12.2 billion, Archer's at $5.7. Does Joby really deserve to be worth double?
Oh, absolutely. And it comes down to their ecosystem and business model. Joby's vertically integrated, they're making their own components, developing software, they even bought the operation side with Blade Air Mobility.
Which is a drop in the bucket for revenue.
It's proof of concept. Joby actually generated revenue $22.6 million in the period ending September 30th. Archer? 0. Vertical Aerospace? 0. Joby's already moving people. Archer's just assembling parts from suppliers. It's a fundamentally different, and I think stronger model.
I come at it from a different angle. Vertical integration is incredibly expensive and risky. Archer has stability from Stellantis. They have a factory in Georgia ramping up without the huge overhead Joby's taking on. I mean, look at what Joby just did. They bought that massive facility in Dayton, Ohio for $61.5 million.
To double their capacity, they're targeting 4 aircraft a month by 2027.
But they're burning cash on manufacturing assets before they even have a certified product. It's the classic cart before the horse problem. They're scaling up overhead while they're still in the TIA phase. If certification slips by just 6 months, that Dayton facility becomes a $60 million albatross. Archer's approach looks a lot smarter when capital costs you 15% dilution.
It's not an albatross, it's a signal of confidence. And speaking of confidence, let's talk about who is really backing this. It's Toyota.
Toyota is a huge partner, I will grant you that.
Significant? They're the lead investor. They own 14 to 15% of the company. They have Toyota engineers on the ground in California implementing the Toyota production system. That's the difference between a science project and a real factory. Toyota does not bet on vaporware.
That is impressive. But while Toyota is buying, who's selling?
I know where you're going with this.
We have to talk about the insiders. Mid-January, right before this news, executives were selling shares. Eric Allison, Didier Papadopoulos. These are the guys running the engineering and manufacturing. That sets off alarm bells.
Okay, I see why that looks suspicious, but let me correct the record. We have to be precise here. Those were sell-to-cover transactions.
They were sales.
They were non-discretionary sales for tax obligations. Look, when they get RSUs and they vest, the IRS treats that as income. They have to pay the tax. So the plan automatically sells some shares to cover the tax bill. Eric Allison still holds over 700,000 shares. This wasn't a lack of faith, it was just a tax bill. Management is still heavily invested.
Fair enough on the tax man, but let's pivot to the real risk that no amount of money can fix, the regulatory catalyst. Everything rides on this TIA phase in the first half of this year, which they've already entered. They've entered it, yes. But this is for credit testing. This isn't Joby's pilots anymore. This is the FAA stepping in, their pilots, their rules. If there is a single issue with those tilting rotors, a single glitch, the stock won't just dip, it will collapse. The whole thesis is binary, and the valuation assumes a flawless execution.
It's priced for leadership, and actually, the market seems to disagree with your risk assessment. Have you looked at the prediction markets?
I track them, yeah, but I'm skeptical of their power in complex engineering.
Well, look at the divergence. We've been tracking the will an eVTOL get FAA type certification in 2026 contract on Polymarket, and this week something interesting happened.
The stock crashed.
The stock crashed on the dilution, but the Polymarket odds for certification, they stayed robust. They didn't move.
That is interesting.
It's more than interesting. It's a signal. The prediction traders see this cash raise as expensive fuel. They see the $1.2 billion as the resource that guarantees the timeline is met. They've decoupled the financial pain from the technical probability of success. The wisdom of the crowd is saying the stock hurts, but the plane is going to fly.
Or it suggests prediction markets are a lagging indicator. I mean, if the for-credit testing reveals a safety issue, do you really think Polymarket is going to hold up? Both will collapse together. And that brings me back to the burn rate. They raised this money because they had to. Their EBITDA is negative $532 million. They're burning $500 million a year.
Growth costs money. You can't build a new mode of transportation on a shoestring budget.
But at this rate, even $1.5 billion only buys them 3 years, maybe less. If the FAA delays certification in 2027, which happens all the time in aerospace, they'll be back here diluting shareholders again from a much lower price.
You're painting a worst-case scenario, and you're forgetting the international wins. Dubai, Saudi Arabia, they have exclusive rights, real operations launching. They are not just waiting for the FAA.
Those are press releases until they are profit centers. The real market is JFK to Manhattan, and that requires the FAA, and that's the bottleneck.
And that is exactly why the partnership with Delta is so critical. Delta has skin in the game, up to $200 million. They're integrating Joby into their app. That solves the demand problem on day one.
Archer has United?
It's not the same level of integration. But okay, this brings us to the conclusion.
Right. So, to summarize my position, Joby is the leader. I don't dispute that. But the price is just too high for the risks that remain. This huge raise proves how capital intensive this is. Investors are paying a massive premium for a company that just diluted them significantly, and that Delta hedge is going to put a ceiling on the stock. I think it's dead money for a while.
And I see the dilution, but I see it as the price of admission. The science project phase is over. With over $1.5 billion in liquidity and operations launching, they've removed the bankruptcy risk that killed others. This dip we're seeing today is a friction cost. It's a chance to buy the sector leader at a discount before the real TAA news starts to hit.
That's the gamble.
It's a calculated risk.
Well, we can agree on one thing. The next 6 months of for-credit flight testing, that's the binary event. That's the truth teller.
It will determine if $12 billion is a bubble or a bargain.
Exactly. So watch the volume, watch the TAI reports, and keep an eye on those short interest numbers.
And watch the skies. Thanks for listening to The Debate.
Until next time.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.